this is the real interest rate assumption. I want us to really take a look at this, Daryl. So this is how the CBO measures real interest rates, and it's okay. It's not a market determined. It's not a forward-looking real interest rate. It's just nominal interest rate on the 10-year minus the CPI. But one thing you can see is we've gone back and looked. I mean, the average value since 1881 up to 2020 is about 2.5%, right? That's the real interest rate. That should say 2.1%. So that's a little on the high side, but it's about 2.1%. And as you get over there, you can see that we're almost all under that average over the next 30 years, according to CBO projection, but particularly in these next 10 years, when the real interest rate is going to be negative for the next, look at that. I believe in the next 6 years, it's negative. And the point is that when the nominal interest rate is growing slower than GDP growth, even though GDP isn't growing very fast, it means you can borrow and it just becomes cheaper as a share of GDP. You don't bear any penalty, right? So if we assume a very different future in real GDP, right, something less like this post-GFC period we had, in general, we had some periods of very low real interest rates, and something more like history, things can get much, much worse, much faster. And a lot of people say, well, why can't we just keep going like we did before? Why can't we keep going like in the last decade where we kept real interest rates low? How? By borrowing from the world, right? I mean, heck, they all have to invest in dollars. I mean, that's everyone has their currency reserves in dollars. Everyone does purchases in dollars. I mean, the dollar remains the only thing in the world that's people really can trust. So why don't we just count on that? Well, then this gets to the next chart. How long can people, how long can we do that? So this is my final chart, Daryl. This is my question.
Yeah.
How long will foreign creditors keep helping us out? This is the U.S. net international investment position as a share of U.S. GDP. That's a trend. Does that look good to you? Doesn't look good to me, right? That is 2020, right? We are in hock to the rest of the world, and we are borrowing basically heavily from the rest of the world to keep ourselves afloat. And that's the future that we think we can sustain for the next 10 or 15 years to keep those real interest rates real low. Now, I do realize that, look, this depends a lot on what the rest of the world will do. Now, if the rest of the world remains in some sort of extremely stagnant, low employment mode, maybe they'll have a lot of extra savings to send us forever. But I just mean to point out, that's where we're resting our future.